All right, thanks for joining today. We're going to speak with Petros from Cornerstone Home Lending. Interest rates are obviously on the top of everyone's mind, buyers, sellers, agents, and the newspapers. And so we want to kind of just cut to the chase on what type of tools and tricks that buyers can use and sellers when they're entering contracts or making offers to make their mortgage payments a little bit more palatable over a 1 to 3 year span.
Thanks, Ashley. So my name is Petros Christophilis. I'm a loan officer with Cornerstone Home Lending, Seattle native, local lender, been in the business for over 15 years and glad to be here.
Awesome. Thank you. So I think, I guess the top of mind right now is like, what is going on in the market? And I know there's been some news just recently, I think, of a little bit of a rate drop. Why don't you tell us kind of what the state of interest rates are right now?
So right now we have been hovering around 7%, good or bad. So slightly below or slightly over. It's been extremely volatile. Today we did see, I would say, a substantial rate drop. We saw rates drop about 1/4 to 3/8 of a point. We're going to explore some rate options today. They are not in real time, just full disclosure. However, just as a baseline, a way to educate everybody, we're going to use these illustrations. But rates are volatile, but they are going to be around that 7% mark, give or take.
When did it cross over to be the 7%? Was that right around August, September?
Yeah, I would say around beginning of October.
Yep, beginning of October.
Yeah.
And then the most recent hike, I guess it was like 2 weeks ago or last week that they had announced a little bit of a increase.
Yeah, that's right. Tuesday, Wednesday last week.
Yep. And could you just kind of explain a little bit, because a lot of people don't know, they hear that and instantly think that, oh, it's going to impact the interest rates dramatically. Can you kind of explain the differences of what that meaning is and how it actually impacts the industry?
Yeah, well, what we've seen over the years we've seen interest rates artificially driven down over the years, just to keep the economy healthy. And because of inflation, we all know that they have to artificially drive rates up. But what ends up happening in mortgages, we are indirectly impacted by the key rate. So the Fed's key rate might impact credit cards, student loans, everyday consumer products, or lending options, and doesn't necessarily mean it's directly tied to mortgage. However, mortgage is following suit. So we're just following mortgage is right behind it, following the Fed's increases.
Got it. Yep. I think, like I said, a lot of people just hear the headlines and automatically think it's going up X amount, but they don't really realize it follows behind, it trails, but it's not necessarily that amount, like the 3/4% hike from, last week, right?
Correct.
So good. All right. Well, do you want to kind of jump in? I mean, the intent of this really is to show kind of buyers and agents really what tools they have in their pockets, and sellers too, to kind of combat the interest rates when they're in these transactions or looking to purchase or looking to sell. So I know there's been a lot of developers and just sellers out there offering closing costs as concessions for different buy down purposes. And you see buyers and their offers asking for that, of course, and then new developers are just offering it across the table, so that it kind of is more attractive to the buyers that are out there. So do you want to kind of explain some of the different programs that you're using?
Yeah, no, this is great. We are finding sellers a little more generous right now and promoting their listings. So right now in rising rate environment, we're looking at multiple solutions. One of them that's grown in popularity is this temporary buy down. So we've heard a lot about this, or specifically a 2-1 buy down. So what that is, essentially the sellers are offering enough of the concessions to temporarily purchase or prepay the interest on a 30-year fixed loan for the first 2 years. So we understand that this is not permanent. So there are multiple differences of a buy down, but the two main ones is a permanent buy down, where you can permanently buy the interest rate down and it stays at that rate for 30 years. This temporary 2-1 buy down is good for the first year, second year, and then third year it goes back up to that baseline rate. So the baseline rate, these scenarios are based on a sales price of $925,000 with 20% down, borrowing $740,000. The baseline 30-year fixed rate is 7% in these scenarios. However, year one, because you're prepaying the interest and the seller's doing this, year one, your interest rate is based on 5%. which then takes the payment down $950 for the first year. That's significant.
Well,
Year two, we have the two, now we're down to the 1%. So 1% less 7% is 6. So the payment is then less $486 per month. Year three, it goes back to the 7%, that baseline rate. And here are our payments for years 1, 2, and then 3 onward. So as you can see, you know, 950 plus 486, or not plus, but 950 and then 486 year two. These are significant. The idea behind this, Ashley, or the hope is in the future, when rates do drop, buyers are able to refinance. The coolest part about the temporary buy down is in the event the borrower decides to refinance before they utilize the 2 years, they get a credit of the difference back. So let's say year one, it has passed, year two, they refinance because rates drop. Whatever unused difference of that buy down goes towards a principal reduction on their loan.
Got it. So in theory, I guess if you add these up as far as the savings, it would be probably right around 18,000, 17 or 18,000.
That sounds about right.
Yeah. And so then so as far as the prepaids, let's say a seller is offering to compensate or participate in this and offer that at closing costs, how much would you be asking in this scenario of a seller?
For standard closing costs?
Yep.
I would say safely 2% of the sales price.
Okay. Gotcha.
Yeah, I mean, that's extremely safe. And that would cover closing costs and prepaids, the taxes and insurance.
Got it. So on just doing the math for people out there, so on 925, it'd be about 18,500. Yep.
And that's on the high side. So gotcha. We definitely have some added cushion in there.
Nice. Great. And then when you look at this versus the 2-1 versus just buying down, can you kind of talk about that? I guess this would be more a better solution for a buyer than doing a permanent buy down, correct?
It depends. It's obviously it's case by case, right? Depends on what the appetite each buyer or borrower has.
Yep.
This temporary buy down has a much bigger impact than a permanent buy down, because it comes to a point on a permanent buy down where it might not actually make sense to pay so much to bring the rate down. It costs a lot of money up front for a permanent buy down as opposed to this temporary. And historically speaking, I mean, many buyers or borrowers aren't in their loans long enough to take advantage of a permanent buy down, or I should say a significant permanent buy down, or enough to match a temporary buy down or get it to that point. Yep. So right now in the space that we're in, you know, Fannie Mae released that article a couple months back. I think it was end of summer. And this is Fannie Mae's statement. They said that they anticipate on seeing rates between 4.5% and 5% in 2023. You know, your guess is as good as mine, but this is a government secured agency that published it. So if that is the case, then, you know, we may all be refinancing sooner than we think.
Yeah. And that's what we've been kind of telling our buyers too. It's, marry the house, date the rate, right?
Correct.
And so I think it's more so about, you know, finding the right home. And then if the event the rates go down, then you could go ahead and refinance at that point. And if not, then you're ahead of everyone, that, you know, you have that gain that you're not paying a higher interest rate in 2023 or 2024.
Absolutely. We have a product, or not necessarily a product, but we're marketing a piece right now where if you refinance with us in the next 5 years, we will pay for your closing costs. There's disclosure associated with that, but if the audience wants to learn more, they can reach out to me.
That's very cool. I like that.
Yeah. Would you like to explore the 3-2-1 buy down?
Yeah, let's do it. Cool.
So similar to the 2-1, this option brings the interest rate down from 7% down to 4% year one. So you're less 3% year one, year two, 5%, year three, 6%. So huge difference on the 3-2-1. Of course, this temporary buy down costs more upfront because you have an additional year in here and it drives the interest rate down. But look at the difference in payment here, Ashley. It's huge.
And so with this scenario, would this be more of like a 3%, 2%, 3%?
Yeah, Exactly.
Okay.
Another solution or option that it was something of the past that, I don't know, it's probably up until 10 or 11 years ago since I've utilized it, but it has been coming up more often and buyers are asking about it. That would be a 40-year amortization loan.
Mm-hmm.
So we have our standard 30-year fix. This extends the amortization schedule, which then reduces the monthly payment.
Mm-hmm.
You're still paying the principal down, just not at the same level as a 30-year fixed. The caveat to these programs, though, when you extend the AM schedule, is it does require a lot higher credentials. So maybe higher FICO scores, a larger down payment, lower debt to income ratios. It also, you might be limited to an adjustable rate mortgage on a 10-year. So there are definitely some tuning to these. It's probably more geared to someone who's has experience with them in the past, but there are multiple options out there. So we're not just limited to a standard 30-year fixed.
Gotcha. Are you seeing any changes in the underwriting or have things relaxed in terms of requirements, or are they getting more restrictive?
No, I haven't seen anything directly here at Cornerstone. I have heard from my peers and at other firms that they're tightening up on loan to value. So they're requiring a little bit more as far as down payment goes, higher credit scores, or one that we rescued someone's file a couple of weeks ago. The lender they were working with did not recognize their restricted stock units as a form of income. So a lot of our tech buyers receive a base salary plus restricted stock units as a part of their income. And that's a huge part of the income. So if we're not recognizing that, it's harder to qualify. As we've seen some volatility in the stock market, a lot of other lenders may fear that, this might be a higher risk to them, but we haven't seen any change on our side. We're still funding these loans.
Got it. And there's still product out there for those who can only put, let's say, 3 or 5% down?
100%, yes. Great product. Great product. And I'd say a large, share of my clients right now are first-time home buyers. We love working with first-time home buyers, and a lot of them are utilizing the 3% down. And it's not just FHA, everyone. This is a conventional product. So Fannie and Freddie have a 3% down product that's phenomenal. And they have one specific for first-time home buyers where they may be able to qualify for reduced mortgage insurance too. So this is something we should look at.
Wow, that's great. Wonderful. Do you have any insights or general feelings on where we're going to be kind of going in 2023?
Come on.
Loaded question. I always hate it when I get that, but I know we don't have a crystal ball whatsoever.
Yeah.
Every day we just take it as it comes.
Yeah. I mean, we definitely we have a little more time to spend reading and investigating a lot of this, but I was with Chief Economic Officer a couple weeks ago, and it was more geared towards Seattle and our greater Seattle market. And, supply issues, product is going to be a continued challenge. But what has also been driving our markets at the same time. So I'm pretty bullish when it comes to Seattle or greater Seattle. This is one of the best places to live in the world. I've traveled quite a bit, and Seattle it's one of the most attractive cities. So we're going to continue to see a lot of folks moving here. Probably going to continue infilling Seattle. A lot of folks, continue to hit the suburbs, and I don't think that's going to change anytime soon. But what might be or continue to be the underlying challenge is supply, and that's going to continue to be the driver. So I don't want to say it looks promising, but I believe first quarter of next year will look a lot different than it looks right now. That's my guess. Yep.
Yeah, and I think everyone's kind of on the same mindset. And again, things could go quickly the other way, but I think we all kind of hope for the best. And we do see all those things in Seattle that are going for it. And, there's things that are out of our control that we can't, but there's also tricks and tips that we can use to help elevate our buyers and our sellers to kind of make the best move that they can in that moment in time. So all this is great information. I think everyone should be kind of putting these different products into play and asking for, closing costs, and sellers should be definitely open to that.
Yeah, I agree, Ashley. And I think it's a lot different talking about it than it is actually looking at these illustrations.
Mhm.
That's been the big game changer. I challenged myself to connect with more folks like yourself. You mentioned earlier that I check in with you periodically, but until we actually look at the numbers visually and see the illustrations, it might not register with us.
Yeah.
So it's like, well, I know about a buy down. Well, there are some misconceptions around it. It is not an ARM. It is a 30-year fixed. You're
Yep.
just prepaying the interest for the first few years.
Yeah, very cool. Good. And I know that there's a lot of people that have been in the industry for a long time too, that when we first started talking about, the 2-1 or 3-1 or even the 40-year, they're like, no way. Cause that was what was used like way back when. So now it's like getting back into it, be like, oh yeah, this is totally viable and something everyone should be looking at right now. So
yeah, it is. Yeah, I agree.
Good. Well, thank you. This was meant to be just kind of a quick check-in and to get your perspective and your advice. And so thank you very much. I really appreciate your time.
Yeah, feeling is mutual. Thank you too. I'll chat with you again, and anyone on this, reach out to me directly if you need any more information. Love to help.
For sure. And we'll post your information too. So thank you so much for all you do and appreciate your time.
Likewise. Thank you, Ashley.
All right. Take care.